So good morning, ladies and gentlemen. Welcome back to the second day of our conference here in Paris, Interest Rate and Liquidity Risk Management, Regulation and the Macroeconomic Environment. So I have the great honor to introduce our second keynote speaker, Professor Raghuram Rajan of Chicago Booth School of Business. Professor Rajan joined the Booth School of Business in 1991 and went on to become a full professor of finance there. He has been serving as a visiting professor in several distinguished places, including Stockholm School of Economics, Kellogg School of Management, and MIT Sloan School of Management. In 2003, Professor Rajan received the inaugural Fisher Black Prize, which is given every 2 years by the American Finance Association to the financial economist younger than 40 years, who has made the most significant contribution to the theory and practice of finance. From October 2003 to December 2006, he served as chief economist at the International Monetary Fund. He chaired the Indian government's Committee on Financial Sector Reforms on years 2007-2008. In 2011, he served as president of the American Finance Association, and in 2016, he was named by the Time magazine in its list of the 100 most influential people in the world. His publication record covers all major journals on the areas of economics and finance. And his more recent research is extremely topical for both our conference today and the general macrofinancial situation globally. So the title of the presentation today will be Monetary Policy, Balance Sheet Management, Liquidity to Financial Stability.
Thank you. Thank you. Good morning. And I hope you can hear me loud and clear. This is based on work with Viral Acharya. We did some theory work together, and then we decided to see if it actually held up in the evidence, and it did. The empirical work is more with also Rahul Chauhan and Sasha Stefan. Can we go to the next slide, please? Or do I have control? Yeah, okay. Let's. So one of the big conundrums in recent times is that central banks have expanded their balance sheets significantly. But somehow, even though we've increased the quantity of the most liquid asset on the planet, which is the central bank reserves, and I'm going to focus largely on the Fed, so Fed reserves, yet it seemed as if there were liquidity shortages building in parts of the market. And this typically tended to accompany the initial processes of quantitative tightening after quantitative tightening had happened for some time, but way before central bank balance sheets contracted to the previous level, the level they were at before the expansion. Way before that, the market started tightening up, the market for liquidity. And so we have had surprisingly fragile financial conditions, given that central bank balance sheets have expanded significantly. First such episode was December 2018, another episode in September 2019, after which the Fed came back before the pandemic to resume quantitative easing. And then you had the dash for cash in US markets in March 2020, when the Fed came back in a massive way, both with quantitative easing plus other new measures. And then we had the turmoil in the UK gilts market, of course, on the back of pretty surprising government measures. But certainly it was again at a time that quantitative tightening had begun. And this year we had Silicon Valley Bank, Signature Bank, and First Republic failing in March 2023. So question is there some connection between central bank expansion, the subsequent contraction, and the building financial fragility. Do financial markets get, in a sense, used to prevailing levels of liquidity? Next slide, please. So what we're going to focus on in this talk is the liability side of the banking sector, and I'm talking here about the commercial banking sector because that is the sector that finances the central bank balance sheets to a large extent. And what we're going to focus on is sustained mismatches between the claims on liquidity that are issued by the commercial banking sector and the available supply of final liquidity as as defined by the quantity of reserves. And that mismatch is going to be the source of some of the tension we're going to talk about. Next slide, please. So the broad insights are that first, when you think about central bank reserves, somehow, at least in my mind, before I started thinking about it, it was as if they were, just additional supplies of liquidity to the market. But reserves have to be financed by the commercial banks. And typically, when you look at how QE is financed, it's not just an expansion of central bank balance sheets. It's also typically a commensurate expansion of commercial bank balance sheets. And typically, the commercial banks finance themselves for every dollar of reserves, as I'll argue, with actually $1.3 of demand deposits and minus -0.3 of time deposits. In other words, they are increasing the claims on liquidity that they issue, and in fact, more than 1-for-1. So what this means is that there is a consumption, if you will, or an additional endogenous demand for liquidity that is created every time liquidity is supplied by the central bank. Now, at some level, it shouldn't matter because when you withdraw the liquidity from the central bank, the demands on liquidity by the commercial banks should also come down. It turns out it doesn't happen so symmetrically. And in fact, when we look at the first period of quantitative tightening, the uninsured demand deposits don't come off when the reserves do. So reserves shrink, but uninsured demand deposits don't, and that puts pressure on the price of liquidity, raising the aggregate price at that time, and basically making clear that liquidity conditions are tightening when reserves are withdrawn. There isn't a commensurate withdrawal of claims on liquidity. The second point I think we will show today is that it's not true that liquidity is in all the right places. Reserves don't remain where the uninsured demand deposits are. They tend to accumulate in some parts of the banking system and leave other parts of the banking system. And it turns out the banks that are most short of liquidity in at least our evidence are the least capitalized banks. They seem to take liquidity risk and become a little more fragile. So in a sense, what you have is at the same time as you're expanding the central bank balance sheet, commercial banks are doing something in parallel, which may, to some extent, increase the risk of financial instability, especially when the central bank has gone some way in shrinking its balance sheet. Now, we focus largely on the first episode of QT, of the end of quantitative easing and the beginning of quantitative tightening, that is 2014 to 2019. When we look at this episode of quantitative tightening, it has been accompanied by significant interest rate increases. And on the one hand, that puts more pressure on banking balance sheets from the solvency perspective. But from the liquidity perspective, we also see that commercial banks have been reducing their demandable claims or have seen some of their demandable claims come off, partly because depositors are taking their money elsewhere. So it may well be that this episode of quantitative tightening works out a little differently. The bottom line, however, regardless of how quantitative tightening takes place, is the central bank gets called in again and again. It needs to respond to the emerging shortages of liquidity, And what that then means is that it can't do it just by infusing overnight reserves, because these are more medium-term shortages. And to actually let the markets function well, it has to come back with medium-term liquidity, which then may conflict with its other policies, such as monetary policy. So if monetary policy is tightening, trying to keep interest rates high, while the central bank sort of has to keep coming back to infuse or increase the size of its balance sheet, that seems to be a conflict. And furthermore, putting back medium-term liquidity runs the risk of, again, ratcheting up demands for liquidity. So we will come to all that at the end. Next slide, please. What I want to start with is just telling you different ways the central bank can expand its balance sheet. The first way, I mean, look at this chart where we have the Federal Reserve. On the left-hand side is the before, on the right-hand side is the after. Let's say the Federal Reserve is engaging in quantitative easing, so it's purchasing securities. And let's say it purchases securities from the banks, okay? It turns out this is merely an asset swap on the side of the commercial banks. What happens is the Federal Reserve buys $1 of Treasury securities. So Treasury securities go up by 1 in the right-hand chart. And it issues $1 of reserves to the banks. And if you look at the banking sector balance sheet below, it has lost $1 of Treasury securities and gained $1 of reserves. So effectively, this is an asset swap. The bank is swapping a long-term asset for a short-term asset. This should make the system more liquid. And this is what people often have in mind when they think of central bank balance sheet expansion. Let's take next chart, please. Next slide. But in fact, what tends to happen during quantitative easing is this, which is the central bank buys treasury securities from the broader public. Think of it buying from a pension fund or an insurance company. And so what happens is, again, the Federal Reserve's treasury securities go up by 1. What then happens is that the insurance company, which has received a payment from the Fed, goes deposits it in its bank account, and that in turn converts into reserves in the bank. So the Federal Reserve, it looks exactly the same. Treasury securities up by 1, reserves held by the banks up by 1. But what happens now is the banking sector has $1 more of reserves financed by deposits, and those deposits are owed to the insurance company. And the public, that is the insurance company, has $1 more of deposits, $1 less of securities. So the asset swap essentially takes place in the balance sheet of the public. Now, all of this can be, the bank doesn't have to maintain this balance sheet after this set of transactions. It can always rebalance. Well, it turns out in practice, it doesn't. And what we'll see is quantitative easing seems to follow this process where the commercial banks expand their balance sheets. And certainly when you look at the period after the end of quantitative easing and through the quantitative tightening, when the central bank shrank its balance sheet, what you find is commercial banks follow the first method, that they're doing asset swaps with the central bank. They're not shrinking their demand deposits. And that's the second point I will try and make when we look at the data. Next slide, please. So QT is not simply a reversal of QE. What happens with QE is a growth of on and off balance sheet demandable bank liabilities. You see the reserves expand, but you also see uninsured demand deposits expand. Plus, you see a shrinkage in time deposits, and you see an expansion in lines of credit, which are claims on liquidity on the commercial bank. So you see all this happening. What you see during quantitative tightening is not the reverse. Certainly in the period 2017 to 19, you see no shrinkage of these liquidity claims, but the reserves shrink. So effectively, the the whole financial system becomes even more of a fractional reserve system, with reserves shrinking relative to the claims on liquidity. And that would uh, typically demonstrate itself in the less capitalized banks. So the liquidity mismatch, in a sense, also migrates within the banking system at this time, creating financial fragility. Of course, when that fragility expresses itself in liquidity shortages in the system, liquidity stress, as for example in September 2019, the central bank comes in and ratchets itself, ratchets up its balance sheet again. And essentially, there is a worry that it's very, very hard to exit quantitative easing and shrink the balance sheet significantly, because the system has gotten more dependent on liquidity and finds it hard to wean itself. A kind of addiction. You can draw the analogy to drug addiction, but really it is a form that has to be dealt with in a careful way. So bottom line, we don't make this point as much in this paper, but QE may be less effective than envisaged, while it may be, while QT, that should be QT rather than QE, while QT may be less easy than believed. Once upon a time, Janet Yellen referred to QT as boring as watching paint dry. It may be less boring than that, because the system has gotten used to the level of reserves. Next slide, please. So this is essentially a graphical picture of what I've just been talking about. These are the reserves held by commercial banks as a fraction of GDP. And what we plot this over is right till recent times. The vertical lines reflect the different episodes. The first vertical line is really the first quantitative easing in the US. The second is when the second quantitative easing started. The third is the third quantitative easing. And then we have a period after quantitative easing ended in 2014, when actually reserves drifted down, but there was no effective, quantitative tightening. The Fed wasn't deliberately shrinking its balance sheet. It was just not expanding and running off a little bit. Um, QT1 starts in 2017 October, and then in September 2019, the Fed gets worried about too little liquidity in the system. And if you look at the chart, reserves in the system are substantially higher than they were before quantitative easing started. So the system is backing up, is having problems, even when you haven't are nowhere near the old level of reserves, suggesting the level of reserves that are necessary has gone up quite a bit. Then you have the pandemic. You have the initial QE in September 2019, and then the huge QE in March 2020. And more recently, since March 2022, we've had a drop off, a process of quantitative tightening. This time, reserves have come down sharply, but let's go to the next slide. What you see here is that demand deposits. Actually, this is just deposits. Deposits are also going up with reserves, and they're going up steadily. The scale for deposits is different. It's on the right-hand side. It's much larger than reserves. But you can see that at the time that the pandemic QE happens, a lot of it is financed by deposits. Next slide, please. And the last piece of demandable claims is credit lines. These are credit lines drawn down, and that's why what you see is an initial shrinkage during the crisis in 2008. That's because firms are drawing down on their credit lines, but then you see steadily, it's increasing. So these are undrawn credit lines are increasing over time, and these are further claims on liquidity that the banking system is writing. And as you can see, during the whole period of quantitative tightening, credit lines aren't coming down, they're staying high. So the claims on liquidity are not shrinking at all even as reserves, the ultimate satisfaction of that liquidity, are shrinking considerably. Next slide, please. Now you can break this up into uninsured demand deposits, insured demand deposits, etc. This is a little crowded slide. Focus on the dark line up above. That is uninsured demand deposits. And basically, a lot of the action has to do with the uninsured demand deposits going up and time deposits coming down. If you look at the bottom two lines, they are time deposits, insured and uninsured, and they have been coming down as the uninsured demand deposits have been going up. So if you look at the claims on liquidity issued by the commercial banking system, it is becoming much more demandable over this period. And that's partly the big offset to the reserves that have been supplied. That's why liquidity is not plentiful. Let's go to the next slide. So what I want to show you is move away from the big aggregate charts to show you some time series evidence on the quantities of demandable claims as well as the price of demandable claims. Then given that so much else can be going on at the same time at the macro level, I want to show you, across banks in a panel, what is happening. Is there a correlation between reserves and the claims specific banks issue? Does bank with more reserves issue more claims? Of course, here we have to be careful about instrumenting for the level of reserves, because that might be endogenous within a bank. And then I want to show you a similar point on the price of liquidity. Banks with more reserves tend to push down the amount they're willing to pay for term deposits, suggesting that they are willing to take more liquidity risk, and that reflects in their lower spreads for term deposits. And finally, I want to give you some data on recent episodes of financial fragility, showing that the banks that are most exposed liquidity-wise are also the ones that have experienced this financial fragility. So let's go to the next slide. So this is the aggregate time series evidence. Next slide, please. So what we're going to show you is whether let's say on the left-hand side, we have a change in demand deposits. On the right-hand side, we have a change in reserves, and we want to see whether the alpha or the measured coefficient estimate for the change in reserves on deposits is positive. And we're also going to correct for lagged reserves. And this is just a simple regression to try and establish more carefully what we see in the aggregate time series charts. Next slide, please. So unfortunately, this is a little small, but let me focus. The left-hand side is in logs. The right-hand side is just changes in levels. And what I want to focus you on is column 5. When you look with the left-hand side, be the changes in aggregate deposits of the banking system, and the explanatory variable is a change in the reserves. There seems to be a coefficient of 1 on reserves. For every dollar of reserves, deposits go up by 1, which seems consistent with the fact that these are mostly financed by deposits, and the banking system doesn't need additional capital to do this. But when you look at breaking up the deposits themselves into time deposits and demand deposits, you see that what you see for every dollar of reserves is that demand deposits go up by 1.4, almost 1.36. And time deposits come down by 0.23. This is exactly what we saw in the charts, but it's basically saying that even as the banking system is financing with deposits, it's changing the maturity of deposits and shrinking them. That's suggesting that it's basically saying we have very liquid assets, that is reserves, and we're going to finance them with the cheapest form of financing, which is uninsured demand deposits. I'll show you uninsured in just a second, but right now it's demand deposits. And we also see that every dollar of reserves results in an increase in credit lines also. That's another facet here. Let's go to the next slide. And this is where we come to the uninsured. Again, focus on columns 5, 6, 7, and 8. And what you see is that in column 7, every dollar of reserves is financed by about 0.8 dollars of uninsured demand deposits. And as you know, uninsured demand deposits are, perhaps the most flighty form of financing you can get, much less financed by insured demandable deposits. There is obviously some, but uninsured is a bigger chunk. Next slide, please. Now, what I want to do is turn to the pricing of liquidity, and Annette Wissing-Jorgensen and Lopez Salido have a very interesting paper where they look at the pricing of liquidity in the U.S. system, and as a measure of the price, they take the effective Fed funds rate minus the interest on reserves. The effective Fed funds rate is what reserves are trading at in the open market. And the interest on reserves is what banks are being paid by the Fed. So that spread, in a sense, reflects the abundance of reserves. If there are really a lot of reserves in the system and people don't want them, they get pushed into the Fed funds market, and that depresses the price there relative to the interest on reserves. So this is a measure of how tight the system is, and the earlier view was that this should depend basically on reserves, and people didn't think so much on claims on reserves. What Annette and Lopez Salido do is they put in deposits in there, and they find that deposits matter as a sort of consumption of liquidity. It sort of will more deposits in the system will enhance the spread. It's a claim on liquidity. And we add in credit lines, and we find that also matters. And of course, you can do this in differences so as to deal with problems of non-stationarity. Let's go to the next slide. So this is an example of how the chart looks if you don't correct. What you have on the left-hand side is just the effective Fed funds rate minus IOR plotted against reserves, and you see there's not much of a slope. But once you correct for deposits and credit lines, you find a pretty sharp slope. So that's basically saying you need to deal with the claims on liquidity in order to price liquidity properly with reserves. Let's go to the next slide. Another way of saying this is that if you run a rolling regression on of the effective Fed funds rate minus the interest on reserves on the reserves and uninsured demand deposits, and plot the coefficients on reserves and uninsured demand deposits separately, what you see is there's a sharp sort of valuation of reserves as liquidity, both in the period of quantitative tightening in 2017 to 2019 and in the quantitative tightening that started in 2022. In other words, the market seems to believe a dollar of reserves is worth a lot in terms of spread at this time, and more reserves brings down the spread considerably. Flip side, more demandable deposits is going to increase the spread considerably, and that's what we see in the right-hand chart. And both these are important in order to assess the available excess liquidity in the market. Next slide. So in a sense, to summarize the point we've been making so far, there was a belief that the demand for liquidity was exogenous, and that when you supplied more reserves, that should push down the price of liquidity because, given an exogenous demand, more supply should price it down. So increasing the supply of reserves is stabilizing. And certainly that is true in the short run. The question is longer run, when you have more reserves outstanding, but then next slide. But then you have an endogenous demand, which is new liquidity claims written by banks. Then it's not at all clear that the price of liquidity in the longer run is actually brought down by this greater supply of reserves, because now you have a whole bunch of new claims on liquidity written by the banks, and that can shift the pricing in substantial ways. So liquidity conditions really depend on how both these claims evolve, not just one. Depends on how reserves evolve, but also on how the claims written against reserves evolve. And that's really the simple point we're making. Going forward. Next slide, please. So what I want to now turn to are the panel tests, and I want to try and finish in time to give you time to ask questions. Next slide, please. So the time series evidence thus far suggests that reserves do affect the claims on liquidity held by the banking system, and demandable claims increase, time deposits shrink, and you have to account for these to price liquidity. But of course, the problem is the time series tests, can't isolate macro factors going on, such as changes in interest rates, economic activity, etc. So we go to panel tests. Next slide. Now, when we go to panel tests, we have to recognize that while reserves can be thought of as exogenous for the banking system as a whole, it is endogenous for each individual bank. And it may be endogenous in ways that complicate our tests. For example, a risk-averse or an LCR-constrained bank may seek higher reserves and also shift towards higher time deposits and lower demand deposits or credit lines because it's trying to build a stronger balance sheet. And so you might then see endogenously a correlation, positive correlation between reserves, time deposits, and a negative correlation with demand deposits and credit lines because of this endogeneity. So what we do is we try an instrument for the bank level of reserves. Basically, thinking of this, we develop a couple of instruments, but let me just explain one. At the aggregate level, the change in aggregate reserves is something the Fed decides based on the needs of the system as a whole. So we take that as exogenous to individual banks. But individual banks may have a different position in the system as far as reserves go. So a money center bank may be where a lot of reserves accumulate because a lot of other entities use that money center bank as their sort of reserve base or their correspondent bank. But what we basically rely on is that your share of reserves over time may be a stable function of the kinds of activities you're in, and can be thought of as exogenous when averaged over share over a certain period of time. And variations in that are the endogenous, but the share itself is a reflection of your basic activity, and that should be thought of as fixed. So our reserve instrument, next slide, please, is the change in aggregate reserves times the average bank share of aggregate reserves. And we're sort of assuming that by averaging away any sort of quarterly variation, we get the bank's general sort of propensity to use reserves, and that is sort of the exogenous component of the aggregate reserves that it accepts on its balance sheet. So what we want to see is whether this exogenous sort of component of reserves actually affects things like the demand deposits it issues and the time deposits it issues. So the basic rationale is the average lag share reflects the location of the bank with regard to picking up the exogenous reserves, whether it's a money center bank or has relationships with non-banks who tender assets to the Fed. Let's turn to the next slide, please. So when we do this, the first stage is basically regressing reserves against the instrument plus other stuff. And the second stage is regressing the variable of interest, in this case, the change in uninsured demandable deposits against the instrumented change in reserves. And we see here again, it's strongly positive for the various episodes, the overall time period, the pandemic QE, the QE episodes, as well as everything except the period of shrinkage, which is post QE3 and the QT. It turns out when you isolate that period when demand deposits didn't seem to be falling, you find in column 4 that that's exactly what the regression also picks up, that you don't see a strong correlation with reserves. If anything, you see a negative correlation. So demand deposits don't seem to be falling as reserves fall during the period of quantitative tightening, even across banks, not just for the aggregate system. Let's turn to the next slide. What this shows is there's also active maturity shortening. So in a bank which has more exogenous reserves, what you find is that the amount it pays, the spread it pays on certificates of deposits of various maturities, tends to be negatively related to the size of the reserves it has. So this is correcting for the overall level of interest rates, correcting for the time period. We have time fixed effects and so on. But what we're basically saying is banks, when they have more reserves, tend to push down time deposits and increase, that's the flip side of it, increase demand deposits. And that's an interesting finding. Let's go to the next slide, please. And lastly, this is showing that in the periods of quantitative easing, you typically find that banks are also selling demandable claims via credit lines. And again, that's a pretty strong effect, especially non-investment grade credit lines, which is where the greatest sort of demands might come in times of stress. Again, we don't see any shrinkage when reserves fall during the period of quantitative tightening. What we see is the ramp up when reserves are increasing during the period of quantitative easing, but not a fall in the period of quantitative tightening. Next slide. So the last part of this is very quickly, I want to talk about what happens when quantitative tightening starts and where the financial fragility might lie. Next slide. What we've seen is an overall ratcheting up of claims to liquidity. And obviously, the big question is, what do banks do when reserves fall? And it turns out they don't shrink liquidity claims. They do substitute somewhat into eligible assets. So if their reserves shrink a little bit, they do seem to buy treasuries, MBS, agency debt. In other words, they're doing the asset swap with the Fed, but not entirely successfully. So if you look at claims to potential liquidity, that is the credit lines banks have issued, plus the uninsured demand deposits that they've issued, and divide that by reserves as well as assets that are eligible for repoing for reserves, you find that that ratio keeps increasing during this time. So fragility to liquidity is actually increasing. Next slide. So the first point I want to make is that even if you look across banks, you see this ratcheting up over this period of uninsured demand deposit financing. Through the periods of QE, what you see right from 2008 is an increase in uninsured demand deposit financing. The most interesting part is the smallest banks. That's the green line, the banks below 50 billion in size, are the banks that are ratcheting up their funding of demand deposits significantly. In 2009, 10% of the assets of the balance sheet of small banks was financed with demand deposits. By 2022, 30% are financed by uninsured demand deposits. That's a huge ratcheting up of liquidity claims on the small banks. Notice that for the large banks, there is some ratcheting up, but nowhere near as much, maybe from 40% to 50%. And even for the medium-sized banks, there has been some significant ratcheting up from 20% to 35%. But so it's really not the largest banks where the ratcheting up of demandable claims is, but the the 250 below 250 billion. And when you think about Silicon Valley Bank financed with 97% demand deposits, that's an outlier for sure, but it's not a crazy outlier relative to what's happening in the system. Next slide, please. And so, a useful way to see this is what is the multiple of reserves when you look at credit lines, uninsured demand deposits, and deposits as a whole, and you find that yes, during the period of QE, the ratio of these claims to reserves came down, but when QE stopped in 2014, it has been moving up steadily. And it took the pandemic QE to bring it down again after it had ratcheted up quite a bit. Next slide, please. And perhaps most interesting here is that this kind of liquidity risk, so claims on liquidity divided by reserves plus eligible assets, is perhaps most pronounced for these small banks. The dotted line below, which is ratcheting up, stay with slide. Yeah, the dotted line below that is ratcheting up. That's the small banks which are below 50 billion, and you're seeing that those are the ones that are expanding most on liquidity risk till quantitative tightening started again in 2022. So those are the guys who are most exposed. In fact, one of the interesting things is to see the large banks, the 250 and above. For them, liquidity risk has come down. And for the small banks, liquidity risk has gone up. So in a sense, the risks are in the wrong places in the system as we entered 2022. Next slide, please. So obviously, why does this happen with the smallest banks? And it may well be that they're the banks that are not subject to LCR requirements. And certainly, if you take the kind of liquidity risk they're taking, it does reduce your costs and increase your returns somewhat. And so if you are searching for yield, if you are looking for higher return on equity, it may actually be an interesting way of doing it, of course, at the risk of big losses when the environment changes. So this is really an example of picking up pennies before the road roller. Next slide. You can basically see in this regression on the x-axis is your exposure to liquidity risk, which is your claims on liquidity plus on your credit line issuances plus your uninsured demand deposits divided by reserves plus eligible assets. That's on the x-axis. On the y-axis is your return on equity. And you see that there's a very strong correlation, positive correlation. So the entities that are taking more liquidity risk are also making more earnings. And in just a bit, I'll show you they also make more losses when the environment turns. Next slide, please. It also turns out, and I don't want to spend too much time on the slide, other than saying that the ones that are boosting ROE more tend to be the ones that are doing more of this are the below median equity banks. They are the ones that by taking on more risk are actually boosting their return on equity even more. So this is a search for yield in some ways, and can come a cropper later. Let's go to the next slide. So, what are the consequences of this kind of risk taking? Well, obviously, it does create exposures to risk even within the system. The system as a whole is exposed, and within the system, there are fragilities building up in certain parts. And one way of seeing this is the various shocks we've seen recently, the COVID shock, as well as the March 2023 system failure. Next slide, please. So one way to look at it is what happened in March 2020. At the outbreak of the pandemic, when we had a dash for cash on bank credit lines by corporate clients. Next slide. And what you see is that banks that have above median of this ratio, that is credit lines plus uninsured demand deposits, divided by reserves plus eligible assets, those are the ones that tend to have relatively low returns. So this is the return differential between those that have issued high claims on liquidity relative to the returns on those who have issued low claims. And you can see starting in March 2020, the returns are about 20% less for this. These are stock returns. So think of this as a kind of event study. The ones that are more liquidity sort of exposed are the ones that fall considerably. Of course, it recovers once the Fed comes in a big way. Next slide. And you can see this before 2020 in Feb. There's really not much of a difference in excess returns. If anything, it's positive for the ones that are more liquidity exposed. But starting in March, you see there's significantly lower returns for the ones that have issued more claims on liquidity. And it's true whether they've issued credit lines or whether they've issued uninsured demand deposits. If you look at credit line drawdowns also, you see that banks that are worried about their bank's liquidity, firms that are worried about the bank's liquidity position would tend to draw down more, and you see the drawdowns are higher for those banks that are more liquidity exposed. They see a greater drawdown in credit lines. Okay, I would like to leave some time for questions. So let me skip, let's go to the next slide. I'll skip a few slides and go to the conclusion. Next slide. Next slide. Okay, let me actually go back one slide. We do something similar during during the March 2023 episode. And again, you can see that those that have more claims on liquidity tend to suffer significant negative excess returns. And it's true whether you issued credit lines or demand deposits, but this time demand deposits become a much bigger factor, in part because there are also concerns about solvency. In fact, if you look at the change in uninsured demand deposits in March 2023, that's where most of the action lies. If you've exposed to liquidity, you suffer a big drawdown in demand deposits over that period. So in 2020, it was credit lines that were drawn down. Not big concern about bank solvency. 2023, because of the interest rate increases, more concern about bank solvency, and demand deposits get withdrawn at that point. So let's go to implications. Next slide. So basically, tightening post QE is associated with financial fragility, despite massive sort of lending by the Federal Home Loan banks, and despite the fact that the Fed still would suggest we're in excess liquidity because you still have money market funds holding significant reserves. So basically, the point is the system tends to back up. It tends to get used to a level of liquidity, and Fed intraday support may not be enough. It may need to come back to make sure that the system has enough. Of course, there's moral hazard embedded in it because the market underprices liquidity, enhancing the continuous need to intervene. In other words, the process of shrinking the balance sheet has to be a measured process where the market has to be weaned of its dependence, and you have to be careful not to do it too fast, but obviously you need to start somewhere, otherwise the market gets used to this permanently. Of course, larger the central bank balance sheet, the more fiscal financing there is, the more it interferes with the monetary function, and also there are accidents or places the Fed cannot reach. So there are problems. Let me stop there. We have hopefully some time for questions, and happy to take any questions.
So thank you very much for the excellent presentation. So let's move on to the questions. We start from the floor. So we have the first question here, please. The microphone is arriving.
Hi, my name is Raymond Kim from Northern Arizona University. Just first off, I think really great findings. With the time deposits and demand deposits, it's a very intricate process. Really, I think it's a great paper. I wanted to suggest that there's this spread between interest on reserves and the 3-month Treasury. And I find that spread is very significant for reserves. I have a paper of better than risk-free reserve premiums and bank lending. And that's kind of, so you might have a different results. You might have better results using the interest on reserves minus the 3-month Treasury, not the effective Fed funds rate, because there's still some risk associated with Fed funds. Right. Right. With the whole during the crisis, you're going to have your money tied up in Lehman for years. That's kind of a inconvenience, and you'll also see in senior financial officer surveys that the Federal Reserve did about a couple years ago that banks don't use Fed funds anymore. And they actually. Yep. I mean, if you want, I'd love to forward you that paper.
Do send it. Right. Do send it. I'd love to take a look. And I think you're exactly right. Lots of concerns about the Fed funds. I mean, in a sense, we did this because we were following another paper, but we'd love to see your paper and follow that. So do send it to me, please.
Okay, very good. Next question goes to Klaus Ullmann.
Yeah, thank you, Raghuram, and thanks a lot for a very, very good presentation. I have a question on when you distinguish between the QE and the QT phase, if it makes sense also distinguish between the interest rate environment. If you are doing QT at a time when there are low inflation, low interest rates, or when what we have seen in recent years, strongly increasing interest rates, which are immediately affecting, for instance, the balance between overnight versus term deposits and having immediate implications on the cost of liquidity and also the structure of the liquidity, the liability side. Thank you.
Again, you're right. There is a seemingly big difference, and much of this paper, this reflects the time to work. Was developed before we saw the effects of this new phase of QT, and with higher interest rates, but also with the this whole discussion of deposit betas and whether deposit betas are reacting much more this time around and becoming more positive more quickly. I think what we're seeing is a shrinkage, maybe not willingly by the banks, but even unwillingly, we're seeing a shrinkage in demand deposits as people are looking to money market funds for market interest rates. And also, as you know, during the March 2023 episode, there was a lot of flight to quality of deposits also towards the big money center banks. So this time is different as far as QT goes. But in a sense, it's not any better because last time, there wasn't any big quantitative movement away. It was just liquidity itself. This time we have liquidity plus solvency plus interest rates, I guess interest rates contributing to solvency. So it's actually a more dramatic episode, and we need to talk about how it's different.
Very good. Any additional questions? If not, so I have one kind of more high level question, maybe related to one of your more stylized fact charts at the beginning when you was showing the evolution of the reserves or central bank balance sheets over time. So, and the observation was that the liquidity shortages were happening progressively at the higher levels of reserves in the system. So have you thought about, could there be also a reason behind the changed liquidity requirements, liquidity regulation that has come into play essentially more or less during the same time that the first episode of the QE were taking place? And now basically the system is reacting just differently because there is a regime shift in the behavior of the banks.
Yeah, no, I think that's part of the explanation, and certainly Darrell Duffy has written a lot about the system requiring more liquidity now than it used to for a variety of reasons, including regulation. So I think that's part of what's going on. But to some extent, we there was actually a Fed study done, and there's a paper by Laurie Logan, which basically says before the September 2019 episode that that there was plenty of reserves in the system, even accounting for these additional requirements. So maybe we learn empirically that the requirements have increased. What we're suggesting is even above the regulatory changes. It's these, your lines of credit haven't gone down, and those are claims on liquidity. So there are these other factors, and unlike the the regulatory requirements, which are basically steady, these ones will get magnified in times of stress because as we saw. When everybody is drawing down their lines of credit, you want to draw down your line of credit because you don't know if your bank will have the liquidity when you need it. And similarly, the standard deposit run, you want to be taking your money out before. So these claims on liquidity can actually be magnifying whatever is also being done by regulation. There is a question on chat, and just very quickly, is there a difference in our study between excess reserves and required reserves? Required reserves are relatively small in the US system. So we don't distinguish between excess reserves and required reserves, but we can actually look at that number and we'll get back to the question. This is Franco Stragiotti. We'll try and look at that number, but we haven't done it. We haven't separated it.
Excellent. Thank you. Thank you very much, Professor Rajan. We are just on time, and with that, I will close this keynote speaker session. Thank you once again.
Thank you.
And enjoy your rest of your stay, I believe, in Frankfurt. And we are moving on to the next contributed session. And Despot, please.